Order blocks. You've heard the term, but almost nobody explains it in a way that actually makes sense. Today, I'm giving you the only strategy you'll ever need. Simple, repeatable, and something beginner traders can start using today. Let's get straight into it. Welcome guys, and if you're new to this channel, my name's Danny from FX Trader 2024. And today we're talking about order blocks. Before you can trade order blocks, you need to understand what they actually are. An order block is a zone where smart money, like institutions, banks, and hedge funds, so the big players as to speak, place orders that move the market rapidly, with momentum, with volume, shall we say. So instead of guessing, we follow the footprints of the big money. Order blocks come in two types. So bullish order blocks, areas where market reversed upwards after a final move down. So here we can see the markets pushed upwards. Bearish order blocks, where the market reversed downwards after the final move up, like so. Think of them as real support and resistance with logic. To keep this beginner friendly, I have 3 rules for a valid order block. Rule number 1, it must be the last opposite direction candle before a strong move. So here we have the last opposite direction candle before the strong move down. As you can see, this is the swing low to the swing high. The last candle pushed up before the sellers came in control, pushing the candle back down. So as this is the swing low to the swing high, this candle here would be the last candle in the opposite direction before the big move down. And now if you look at a bullish order block, this would be the last candle in the opposite direction before the big push up from the swing high to the swing low. So that's rule number 1. Rule number 2, the move away must break structure or change the character at least. If price wiggles away, it's not institutional. It has to be a strong move that breaks the structure. So when I'm saying break the structure, let's get the path tool out. We have a push down that can't break past the previous lower low, and order blocks been created. We've had a big push up. Now this leg up broke this structure here, changing the character. That would be valid. And now on a bearish order block, we had price coming down, we've had a retracement, creating an order block which gave this huge push down, breaking this structure to the downside. And number 3, last but not least, price must return later to mitigate it, meaning price must return back to the order block to mitigate the order block. For example, an order block's been created, we've had the huge push down. Price has now returned to mitigate the order block before the true move down. And on the bullish order block's been created, price pushed up, returned to the order block, mitigating the order block before another push up. Here's the full strategy step by step. Pause the video and take notes because this is gold. Step 1, identify the trend on a higher time frame. This can be from the daily, 4 hour, 1 hour, 30 minutes, all within them time frames. So as you can see here, we are on a clear downtrend as we have broken structure to the downside every single time. Coming to this area here, we have reversed and now pushed up. Our job is to identify the order block and to find out which direction is the market going to be going in. On downtrends, we're mainly looking for bearish order blocks. We have found a bullish order block in the opposite direction. Usually, we only trade order blocks with the trend, not against it. On this occasion, we are trading against it because price has changed character on the higher time frame, and it will be creating a new direction for higher highs, creating an uptrend. Step 2, mark the most recent valid order block. So if we zoom in, we have now marked our order block. So once we've marked out our order block, we drop to a lower time frame to find our entry. In this case, we are on 30 minutes. we will drop down either to the 15, 5 or 1 minute and look for an entry. So if I drop down to the 1 minute, we can see price return to our zone, which is this blue marked out area here. We will start looking for confirmation. So step 4, when price taps the order block, look for a lower time frame signal to take an entry. So what we're looking for is market structure shift on the lower time frame, break of internal trend, a rejection wick, or possibly an engulfing candle. This will prevent forced trading and creating entries that are not even there. So here we've had our rejection wick. Price didn't go too deep into the order block. It just wicked from the top of the order block. But still, there's no entry here. Price rejected with a wick and it just consolidated sideways. We had another push down until we had the market structure shift, which caused a change of character. This is where we would look for our entry. Now, if we were aggressive traders, we would have entered here. Let's just put the position tool here and I'll show you how you can get a sniper entry when you wait for confluences. So if we entered aggressively, we would have entered here with the stop loss below the order block and price pushing up. So if I just go to the higher time frame, we can see this would have given us a 1 to 7 or possibly 1 to 8. Now, if we drop back into the 1 minute, I will show you a refined entry with confluences. So now we've had a wick rejection, slight consolidation, and a market structure shift. So a change of character. So now we can see price will start pushing up. But how do we find our entry? The order blocks here, price is pushed up, causing a change of character, market structure shift. That's one confluence. Second confluence would be we go from the swing low to the swing high and we target anywhere from the 50% and below to get a discounted price. As you can see, price has tapped here into the 50%. But where would we take our entry? We just slightly zoom in. This 50% area has a valid fair value gap. So if we remove this Fibonacci retracement tool for now, we can mark out our fair value gap. As you can see, price rejected from this. And now if we put our retracement tool back on top, we notice that it's coming to a discount price as it's hit 50% and it's reacted from this fair value gap. So we could now take our refined entry, our sniper entry, like so. We tighten our stop loss. You can either put the stop loss below here or you could keep it really tight just below the fair value gap. To be extra safe, you could keep it just around about here. So below fair value gap. So that's step 5. Setting your stop loss. Either you can have a huge massive stop loss like this. So for example, if this trade is a 1 to 7 and you're risking $300 here, your take profit would be $2,100. So that's a 1 to 7. You're risking $300 to make $2,100 as this is a 1 to 7. Now on our refined sniper entry, the stop loss would be a lot tighter. So you could risk $300 here, and if your take profit was the same as the 1 to 7, which is here, your trade would now become a 1 to 31, which is very rare, but they do happen. So if that's a 1 to 31, you'd be risking $300 to make $9,300 in one trade, all because you waited for confirmation, confluences, and a sniper entry. Now to take profit, step 6, where would you exit your trade? So if we go back to the 30-minute time frame, this is how you would find your exit strategy. You'll take profit. So on the downtrend, every time there was a lower high, a pullback, which is a retracement, it leaves liquidity. A lower low, a lower high, another retracement, which leaves liquidity. A lower low, a lower high, which left liquidity, and a lower low. You could redefine it on a 5-minute time frame, but I'm just going to show you now as we're on a 30-minute time frame. So your first take profit, if you were on this aggressive trade, your first take profit would be here. This would be a 1 to 3 as there was liquidity here due to a retracement. You look to the left. Your second take profit would be here, which is a 1 to 3.3, which is still roughly around a 1 to 3. Your next take profit would be here, which is a 1 to 4, almost a 1 to 5. And then you could target these highs. If you was a swing trader, you could let the trade run up until here. But we are talking about day trading. You could do the same for your sniper entry, depending on where you'd like to exit. So it doesn't mean you have to just push the take profit all the way up and wait until it hits your profit target. No. If you feel it's safer for you to exit in these areas of liquidity, you can just take your profit in those areas. So now that was for a bullish order block. Let me show you an example for a bearish order block. Step 1. Identify a trend on a higher time frame. We identified a downtrend on the 1 hour time frame. We found a bearish order block. So mark the most recent order block which caused a break of structure like this one did to the downside. So we only trade order blocks with the trend, not against it. The previous order block I showed you was a bullish order block and did go against the trend, but worked perfectly perfect. But that doesn't always happen, so be very careful. Always trend an order block with the trend, not against the trend. So now that we've marked our order block, which caused the break of structure, we would drop down to a lower time frame to find the perfect entry. So here we could go to the 15-minute, and I'm going to show you 3 ways we could take an entry here. We could have taken the aggressive way, which would be to place the stop loss above the order block, and you could catch a nice 1 to 3 here. Or you could do another aggressive one, but a refined stop loss where you could see price pushing down out of the order block, but not creating a market structure shift. You could get the Fibonacci tool from the swing high to the swing low, watching it go above the 50% area. So now we're in a premium price to sell off. There's an order block here on the 15-minute candle. So if we just remove this, as we know we are in the discounted price, we can mark our fair value gap. We can see price tapped into the fair value gap, and we can have an aggressive entry, which I don't recommend, by the way, but you can enter. So if we put a short position with a tighter stop loss, again just above the order block and targeting the same area, we have changed the trade from a 1 to 3 now to a 1 to 13, almost 1 to 14, just by getting one confluence. But now here's the thing. If we waited for a confluence, so price has come into the order block, rejected out of the order block, creating a market structure shift as it broke structure to the downside and leaving a fair value gap, we could mark from the swing high to the swing low, and we have noticed that price has come in above the 50% area, and we've had 1, 2, 3 rejections. Price has come back into it again, and it cannot break past this area. So here's the fair value gap, but price cannot break past this zone here, which is in a premium area for us to take sells. So now if we get the short position tool out, we can place our stop loss. Either you can place it here, so just outside the fair value gap, or you can close the gap. As you know, the price is not breaking past this area, and have a tighter stop loss, and then target the lows. And if you look to the left, you can see all your take profit areas where you could take profit. And if you let the trade play out, this trade would now become a 1 to 38. So if you risk $300, you would make $11,400. Thus, how you get a sniper entry, guys, with confluences. So make sure every time you're taking a trade, wait patiently and wait for confluences, and then take your sniper entry. So a quick summary of what you learned today was how to identify an order block. We only trade order blocks with the trend and not against the trend, unless you find a valid break of structure. You drop to a lower time frame to find an entry with confirmation and confluences. You learn how to set your stop loss and how to take profits and what areas to take profits from. You also learn how to get a sniper entry and how to tighten the stop loss. So the biggest mistakes the beginners make, most traders lose with order blocks because they trade every order block they see. They ignore the trend direction. They don't check if it's an uptrend. Are we trending downwards? Is it a downtrend? Or is the market just consolidating? They enter too early. They don't wait for confirmation and confluences, and they don't know how to pick the correct order block. Fix these 5 and your win rate skyrockets. So you're looking for a higher time frame trend, uptrend, downtrend, and order block selection. So that's the order block strategy. One setup, one framework, and one repeatable system. If you master this, you will understand the markets better than 90% of the beginner traders. And if you're ready to take this to the next level and actually trade like the institutions, I've put my full trading course in the description below. Inside, we go deep into market structure, liquidity, premium and discount pricing, and my exact institutional entry models. And if this video helped you, make sure you subscribe, hit the like button, and drop a comment to help the channel grow. Also, check the link in the description below to get access to the full course. And I'll see you in the next video. Peace!